Hey everyone, welcome back to the Money Level Show. We think, act, and prosper. Today, we're going to get into a few different topics. I got my good friend Benjamin coming on to the live stream here soon. We're going to talk through some of his recent stock valuations as he is very active in the natural resource sector. So, we're going to talk about that. We're going to talk about inflation as well as best strategies to survive. Recession. That's the elephant in the room, if we're going to have a recession or not. We're getting a lot of controversial topics on that. I received a lot of headlines recently that with inflation being cooled, that we're likely not going to have recession, all these different things. But I'm hearing some other contrary information on the front of other nations that are experiencing recession, and and it's not looking good. So we're going to get into a lot of these different topics today. But for now, let's go ahead and kick the intro. Benjamin will be on soon, but we'll get to it.
Think, act, and prosper. You are now tuned into the Money Level Show.
Everyone, we are back. Glad that you all are here with me. I'm going to go ahead and add in my guy Benjamin to the stage. Let's go ahead and get it in. Ben, what's up?
How are you, DT? Can you hear me okay?
Yes, indeed. You're live on the stage. You know, we're live streaming, trying to make this a little more simpler. We ain't got to go do a bunch of editing and stuff. So it's always good just to be able to just do it organically like this.
Yeah, absolutely. I'm all for it.
All right, cool. So from the audience, can y'all hear Ben okay? Can y'all hear me and Ben okay? If you could drop a comment below, if you can hear us. Ben, can you check your audio? I don't know if it's connected to your mic or not.
Okay, let's see.
Then I'm getting a little feedback, so I'm wondering if it's your computer picking up.
Yeah. Okay.
Loud and clear, right, Banana?
All right, now I'm connected. I'm connected to the big fella, the road.
Yes, indeed. Yeah, sounds a lot better. Right, Banana said he can hear us loud and clear. I'm trying to think where you at on that picture. I don't know whether to keep calling you Right Banana or what, but
it's like a switchboard map kind of deal.
Yeah, definitely. So appreciate you tuning in. How you doing today, man? What's happening on your end, Ben?
Just a lovely Sunday morning here in Australia. The birds are singing in my garden here. The sun is shining. I'm just receiving notifications of dividends coming in over the quarter. So
Ooh, nice.
Very relaxed.
Which companies are you receiving divvies on?
Oh, DT with the secret questions. So the two main ones that are no secret, I've been speaking about them since the start of the year. Ecopetrol and Petrobras are two vertically integrated behemoths down in Latin America, Colombia and Brazil, respectively, are still paying me out healthy double-digit dividends. And a couple of the companies that I believe you might want to speak about today, I'm very, very excited for in terms of dividend investing into the future. And particularly the tanker markets are looking very, very juicy. So yeah.
Nice. Yeah. So just really quick to the comments. Right, Banana said the gum wall and Pike Place Market. I know exactly where you're talking about. I was thinking that was it. I didn't say it, but I was thinking, is that the gum wall? But I felt like it may have been weird to people that don't know what the gum wall is. But in Seattle, they have this wall that's just painted with, everyone just goes and sticks gum there. So it's just a lot of different colors and things like that. So glad that you're tuning in Washington. I'm in Washington State too. So appreciate you for tuning in. Right Banana, my guy Avery Turner. I love dividends. Avery is always on Twitter talking about the divvies and the valuations and the charts and such. So Avery is always active on Twitter. So I encourage you all to follow him. Avery, drop your handle in the chat. I'll be sure to put it on the screen. So I'm glad to have you here. So yeah, so Echo Patrol and Petrobras, right? So I've talked about them multiple times on the channel, and they're paying a hefty dividend. Did Petrobras, did they reduce their dividend recently, or they're still paying 25%?
So the yield has gone down slightly on the preferreds, which I mainly own. I use the straight shares for options trading, but you're still looking at around about, by my calculations at least, around about a 15-16% annual yield. And I like what the company have done. They've reduced some of their payout ratio in terms of the profit that the company makes. Instead of paying out in the high 60s, they reduced it slightly towards a sort of 40-45% distribution, and that savings, if you want to look at it that way, will be used in terms of maintaining and increasing their production over the next decade. And I think what people really need to understand around Petrobras in particular is if things go the way that I think you and I believe they will in the oil markets, when you get to the end of this decade, it's really going to be about who can get oil to the market. And those guys are investing heavily in the pre-salt and Guyana area. And I think that they're going to be the ones that at the end of the decade, where people are really struggling and will have to pay up for production, Petrobras have already invested in their production and in their offshore service vehicles. So, yeah, I'm very bullish on the company.
Gotcha. That's good. Avery responded with his Twitter handle. Be sure to go check him out on X, Twitter. He posts a lot of stuff. He follows me, retweets some of my stuff. So appreciate you, brother, for joining in. So Petrobras. I'm just gonna share screen here. So it's kind of interesting with Petrobras. I didn't know that they actually that the government owns a lot of their shares.
Yeah, that's a really good point, because anytime some of the bears come out of the closet, or come out of the woods, probably better to say, around Petrobras, they say, oh, there's political risk and nationalization risk. Well, to my way of thinking, it already is nationalized in a lot of ways. The government owns the majority of the shares. And so I think that there is quite a misstated risk in terms of nationalization. Similar deal, Ecopetrol is even more nationalized in brackets, where we as investors, we're only able to buy, I believe it's less than 10% of the available float. And the rest is the Colombian government. And similarly, the Brazilian government owns the majority shares in Petrobras. So that's actually, if you think about it, you and I have talked about, we want management being invested. We want them to own most of the shares so that they have skin in the game. Well, I mean, this is essentially the same thing. The government has their skin in the game. For them to balance their books, they need to manage these companies well. And so that's exactly what we want as shareholders. And if there were fears around them doing silly things like expropriating the rest of the float, they'd only be shooting themselves in the foot in the long term. So it's a good point that you make around the government ownership. I think that really needs to be better understood.
That was exactly what I was thinking about, with the government, shooting themselves in the foot if they are to issue some certain type of regulations or whatnot. I mean, it's going to hurt themselves. And this is what we're seeing here from major holders, right? Where, it doesn't even show government on here, right? It just shows 21% held by.
Yeah, I believe that that will likely be because what you're seeing is the percentage of publicly available shares. Mm-hmm. So there will be shares that are not publicly available, obviously, and that's where the government ownership will lie, as far as I can make out. Yeah.
Yeah. So, you got some big names on here: Morgan Stanley, Goldman Sachs, Arrow Street. I mean, these people own quite a bit of shares, and so I mean, you even have mutual fund holders here. So it looks like this isn't a stock that's really on a lot of people's radar in terms of, at least, but they're
I don't
paying.
know how. it's, it's right up there with the number one producer in the world, like your Exxons and your Chevrons, but it trades for a quarter of the valuation. And Rick Rule and I have mentioned this in a podcast we did in the past. Yeah, 100%, man. And I think that what you'll find, what's super important to think about, is a lot of companies in the index have a yield mandate, a dividend mandate, so that they need to be, certain ETFs need to be looking for yield, be it in bonds or be it in dividend paying stocks. As credit conditions tighten and the tech companies are no longer able to finance a lot of their business at cheap interest rates, they're going to have to start cutting their dividends. And I think when you see that, a few companies, one in particular that I have a short position on, will drop out, and I think you'll see a rotation of capital. Those institutional funds that you mentioned, why are they going to start paying 30, 40, 50, 60, 80 times earnings with no yield when they can buy some of the best producers in the world and yield 15, 16%?
Yeah, definitely. That's good. Yeah, I'm glad just to have you on, just so we can. So, if the audience, if y'all have any questions or anything, be sure to shoot them out. We'll try to get to whichever ones we can. We got quite a few people viewing right now, so I'm glad that you all are joined with us today. My guy GoFlow, appreciate you tuning in. Always enjoy you coming into the chat and everything. We may get some interesting personalities in the chat. So you have been there when these personalities pop up, but we will handle them accordingly. So
we will go with the go flow.
Yeah, definitely. So I wanted to go ahead and just share. We talked about Echo Patrol, so we're going to go over here. And for you all looking, which I don't know how often these sites update their dividend percentages, but I mean, here, Yahoo Finance just projects it at 18.31%. I'm not sure if that's what the company actually announced or what. I haven't been paying attention lately, but they pay a hefty dividend.
Mm-hmm. They certainly do. Currently, I'd suggest that dividend's closer to 20, even 25%. And one thing that's really interesting to keep an eye on is the fluctuation of the Colombian peso. So if you see fluctuations, and this actually happened last dividend payment, you got a 20% increase in the dividend just from the foreign exchange differential. So investors, we did absolutely nothing, but we got a 20% increase in the value of the dividend, which was really nice. A couple of guys you want to follow on Twitter with regards to Ecopetrol, there's August Wilson and my good friend Chapman Scarborough. Those guys really know the companies inside out. And if you want to be kept abreast of all the dividend news, August is always keeping live updates for both Petrobras and Ecopetrol.
Nice. That's good. And so as you all can see, the dividend yield here, Ecopetrol, I mean, damn near 27%. I mean, that's lovely. And the ex-dividend day coming up, I mean, if people want, this ain't investment advice, but you have to own it before this date if you're trying to get 27% on your capital and invest at your own risk, right? So just looking at the holders really quick. Yeah, I mean, just like you said, I mean, like we can only own a certain percentage of the shares.
Exactly.
So yeah.
Another interesting point. Just I don't know how interested people are, but with the political situation in Colombia, I have a lot of contacts there and interest in Colombia. The main reason this stock sold off was the election of Gustavo Petro back, where are we, 2 years ago now, because essentially he's a guerrilla, and he was bringing a socialist platform, or was trying to Colombia. So people were super afraid that he was going to, again, the same fears, nationalize all the assets and all this sort of thing. Well, the guy is failing badly in office. 2 weeks ago, Colombia had elections for various mayors in the main cities, and it was almost a clean sweep. So Pedro lost every seat except for one, and the progressive mayors were replaced with more sort of conservative, traditional, business-friendly mayors. And I think you will see that trend continue into the end of the next year when there are presidential elections. And I think there's a very good chance Gustavo Petro will be a one-term president. The catalyst for the re-rating of this stock, I believe, lies in his removal and a new president coming in, and then the market will have much more confidence. They will be tripping over themselves to buy these shares at 26, 27% dividend yield, and I think the stock will re-rate back to its previous highs of around $20. You can see that sharp decline there around July in
Yeah,
22, and boop, and
yep.
dropped off the face of the earth.
That was the election. And
Exactly.
This is just how the charts respond, to this news that comes out. And so, like, obviously this president gets in office, and then I'm looking here. The election was in May. They were held on May of 2022, with the runoff in June of 2022. So, as you can see, the sell off is just, massive. So, I mean, it goes from, $20 a share to, pretty much cut 50%,
Exactly.
Yeah.
And by the way, if we think about it, $20 a share, this thing was still dividending about a 10% yield, roughly. So it's not as if it was super expensive at $20 a share.
Mm-hmm.
And with those institutional players coming in, remember that small amount of float that's available, everyone's going to be fighting over the 2% of the entire company. So I'm a very, very happy long-term shareholder in Ecopetrol.
That's good. That's good. Well, we're gonna jump to your channel here in a second. So you all just want to share just some of the comments of the day. Dear sir, when you have someone like Lynn Alden, you need to talk less and listen more. I had to respond, dear sir, if you don't like it, you can go to another channel. Sorry, you all. So I hate to be an a-hole at times, but it just is what it is. If you give some constructive feedback, I'm willing to take constructive feedback, but I don't take well to demands and things like that. I mean, like, yeah, it's my channel, my platform, but you all have freedom of speech, so
yeah,
share what you like, right? So just wanted to give a little humor in there. So we're just looking at Ben's channel here. Be sure to go subscribe. It's the ROI channel at the ROI podcast on YouTube. So you've done quite a bit of stock analysis. I mean, recently you got Braxam Chemicals.
yeah.
I have not checked that one out yet. But and then you have Fro, which is Frontline, the tanker. So let's run through Braxam. What was kind of the some of the, I encourage you all to go check the full video out, but what were some of the things that you pulled out of there? How were you introduced to the company and things of that nature?
Yeah, absolutely. So it's a very interesting one. I've actually done 2 videos on Braxam. Back in early April, I believe, I was looking at the company, interested in buying it, and did a valuation. There was a buyout opportunity on Braxam back then, and as I was starting to buy the shares, and they shot up like 35% in a day as I was buying them. So I ended up just exiting because of the price run up. And it looks like I've got another bite at the cherry. Since then, the deal did not go through, and the stock dropped down. And so, in a nutshell, so I don't talk too much, there is a private equity company, Adnor, that's put in an offer for 35% of the shares, but those 35% of the shares have the majority of voting power, and they have offered the equivalent of about $15 per ADR. Okay, in other words, that's about 100% upside from where we are today. When I started buying at about $7.90, so the stock's currently at $8.19. And so the whole idea is, I believe this is highly likely to go through. I have a admittedly speculative position on the company. I'm hoping that in the next sort of 3 to 9 months, the deal can be finalized, accepted, and there would be a nice little 100% arbitrage.
Nice.
Yeah,
So that,
that's the main thesis. I'm not sure if you wanted me to go into other aspects of the particulars of the deal, but
yeah,
I'll be
yeah,
led by you.
yeah, definitely. So what role does this company play into like the broader macro picture?
Sure. So the company itself is a petrochemical manufacturer. So if you think about, we all know about petrol. We tend to think of it as the energy source and fuel source for transportation. There's a big slice of uses for petrochemicals to make things like plastics, plastic bags, containers, all those sorts of things. So this company makes a lot of the plastics as well as other chemicals. Um, it's if you look at the charts, it's a massively cyclical stock. You see the 52-week range from $6 to $12 there, and if you zoom out over time, you'll see it goes up and down and up and down and up and down, to reflect, I guess, industrial demand. An interesting fact, I suppose, is that Petrobras, which we mentioned earlier, they own a huge amount of this share float, and so if investors are not comfortable with Braxham necessarily, if you own Petrobras, you indirectly own a decent amount of Braxham. Okay, so long term, the company it's massively cyclical. So if you're a swing trader, it's a dream for you. The recent sell off is mainly due to the fact that they had an issue. They were operating in a town, I believe in Brazil, and they actually messed up their geo surveying, and they sunk the town. So obviously that's pretty bad. But they have raised a lot of capital in debt, and they have paid out most of the compensation. The market hates it now because of the debt load. However, it doesn't have any more compensation to pay out as a result of their mistake. And so what I think is that I think Petrobras, instead of blocking the buyout, I think they'll be really keen for it because it's a free 100% arbitrage for them. And, that it cleans up a hell of a lot of the debt that this company has. So that's my quick overview of
Mhm.
Braxham. It's a bit of a different one. Obviously, I can't guarantee that it will go through. There are some question marks as to whether the minority shareholders will get the same bid or offer price for Novanor, who are the guys that are going to sell their shares potentially. But having read through the bylaws of the company, it does say that if there's an offer made for more than 50% control, there should be a tag along right to shareholders. So in other words, the minority shareholders should get the same, effectively $15 a share or $15 an ADR, excuse me, which, yeah, that's what I'm playing for in this particular company. If it doesn't work, I will exit. This is not a long-term investment for me, but it's just something a little different, I suppose.
Yeah, just a quick snag and go. So I call
Hopefully.
it. So yeah, so I just wanted to share screen really quick. And just for those who are new to natural resources and such, I mean, we're still early in this trade.
Oh my goodness, yes.
I mean, Robert Friedland, billionaire Robert Friedland, he just actually I didn't know he got on Twitter, but I'm following. So I'm on Tavi Costa's page, who was at the New Orleans Investment Conference, and I watched some of his content for a while. But he shows like how the materials mining as well as the energy sector is just like it doesn't the weight of the S&P 500, it is very, very low. And so yeah, so we're still early in this thing. And then I was looking at Braxham, which is pretty much it's a Brazilian company, from what I see. And Tavi Costa had some interesting charts this year, this past week. I'm just trying to find where he talked about how the emerging markets and the Brazilian stock sector. Here we go. He posts, the significance of this chart is growing by the minute. Brazilian equities just poked their head above a 13-year resistance, likely marking a key breakout. And so, as we can see, he posts the chart here, and these sectors, as far as emerging markets, I mean, they've been getting beaten down for a little while. And so at some point, more attention is going to turn towards these sectors, like in the height of after the dot-com bubble, as well as leading up to the global financial crisis. And so Brazilian stocks, they seem like a good place to be. My recent interview with Lynn Alden, we talked about emerging markets. We talked about Chinese stocks in particular, but then she mentioned that, with so much uncertainty there, she pointed her attention is more on the Brazilian stocks. And so this is something to keep in mind, here. And so, and then he, add some more emphasis. Why would anyone invest in U.S. stocks at 50 to 100 times earnings when you can acquire shares of a well-established Brazilian company trading at just 5 times its annual profits? With strong ties to commodity prices, today's skepticism towards Brazil reminds me of the early 2000s when its respective equity market experienced a remarkable surge of 16-fold.
And another point I would add to that is that during that run-up, most of that was presided over by the current president, Lula. So again, you had massive sell-off when Lula won the election because he's a self-identified communist, and the market just didn't like it and thought that, all hell was going to break loose. Mm-hmm. And guys, I mean, the same guy was president during a large amount of that run-up. And if you look at what he's done, he's often had, not always, but a more of a free market approach. And he's changed the fuel subsidy process that was implemented by Jair Bolsonaro, who was the so-called right-wing president before Lula. So, I mean, you got to look a little bit deeper into these things. And I think that with the caveat, the US dollar will continue to probably be strong over the next, 6 to 18 months. You may see these LATAM producers just kind of grind slowly. But hey, if I'm getting paid 15, 16% yield in US dollars, the dividends are, then, I'm happy to wait.
Yeah, definitely. So just transitioning over here to the tanker market. So we have, let's see, on your channel, we have Frontline Energy, or Frontline, just Frontline. So so with Frontline, I've heard about it for a while. Obviously, I mean, you've done a few valuations on some tankers, which we'll get to Cool Coal in a second. Which that was a pretty cool, interesting one that I started investing in. But Frontline, I've bought on and off over the years. Currently, I'm mostly in DHT.
Good man.
Yeah. What attracted you to Frontline?
So it's interesting. I, for once in my life, actually got the timing right in terms of a market. That never happens. But Frontline and DHT were two tanker plays I was looking at. DHT is my preferred. It's my biggest oil tanker play, and then Cool Company is my LNG tanker play. Frontline is a mixed fleet, so they have more product tankers. So instead of carrying crude oil, you need a different carrier to carry refined, like diesel and refined fuels. And I was looking to increase my position, and the stock just, again, it ran away on me. So Frontline, I think, is the number one player in terms of the product tanker market. They've got the biggest fleet, and the stock has run up a lot. And I had a valuation of around $20.50 a share, and it is obviously a little bit higher than that now. So I'm not buying it, but it's continuing to dish out really nice dividend yields. I like the guy at the helm, Mr. Friedrichsen. Has been in the shipping market forever, and it's just been trying to acquire massive amounts of product tankers. So they were due to merge with Euronav. It didn't go through, but then Friedrichsen has bought a hell of a lot of the tankers from Euronav. And I guess the biggest thesis for tankers is that you just aren't going to have new ships coming online over the next 2-3 years. It's just the market's tapped out, and the shipyards are tapped out. And so obviously if you have a shrinking supply with, unfortunately, global conflict happening, and it just seems to be getting worse by the day. Think about what that does to trade routes. So instead of going through, let's say, the Strait of Hormuz down in near Iran, if things really go pear-shaped and they close that, then what, tankers are going to have to extend their journey. Their day rates are going to go through the roof, and so I think that there's a lot of upside for tankers, particularly frontline. But you mentioned DHT, which is actually my favorite tanker stock, purely because for very large crude carriers, which is what DHT are, they only do VLCCs. There's just nothing left in terms of that fleet. Like they're tapped out. All the ships are being occupied, being used, and I believe they're trading for still a discount to their replacement value. So I don't know. That's where I start to get excited, mate.
Mm-hmm. What so what interested you mostly in the tanker market? Was it like the supply and demand of actual tankers? I mean, obviously you have to get these resources around the world. And then these tankers only last so long. They have so much of a shelf life, and
Exactly.
and so what is that kind of looking like now? I mean, obviously, every company is different, but let's say a DHT, like are they building a lot of new ships, or they have a majority of the market sold up, or kind of like what's kind of that looking like?
Yeah, exactly. So there's less than 2% of the entire global fleet coming online over the next 2 years, if I remember correctly. So in other words, there's no new there's no new tankers coming on over the next 2 to 3 years. And if you look at the age, as you mentioned, the age of the vessels, after really 15 to 20 years, they need a lot of maintenance, and then 20 to 25 years, they just go to scrap. And so you're reducing the supply of available vessels. The shipping market is extremely cyclical, and so it's all about the supply side for me. So if I see a whole heap of new builds coming online, then that'll be the cue for me to take my exit. And it is exactly what you mentioned in terms of the supply demand of the vessels. It just isn't there, and I think that the demand will remain constant, maybe increase for the factors which I mentioned previously.
Yeah.
What more can I say? Double-digit dividend yield, trading at a discount to replacement. It now costs somewhere close to 150 million to build a carrier like that, and with more environmental laws coming in, what does that mean for the old tankers that don't have the fuel cleaners, the scrubbers they call it? Well, they have to be scrapped, and so you reduce the supply more and more and more. So all these factors seem to lead to a bullish conclusion.
Yeah. We haven't even seen, I mean, obviously, I don't know if they probably diluted some shares since then, or that may have been the share price. But usually, sometime when I see these charts, you're like, yeah, the price wasn't that high back then. They added more shares, but as you can see, it's a cyclical market. And the last time that the market was, pretty elevated was, this last natural resource bull market, leading up to 2007. Which the oil market went, to 2014. And so many resources went that far. But as you can see, even DHT, paying a double-digit dividend. So yeah, it seems like a good play.
Yeah, I pulled up some notes I had for the company DHT. So the cash flows that you mentioned are amazing. I'm just looking. I went through the accounting, and the cost of building a VLCC, as I said, close to 130 million. So this company's got about 26 vessels. And if you look at on the balance sheet, 26 vessels, if you were to build them at 130 million each, which right now you can't because the ship markets, the shipbuilding yards are already tapped out, that's around $20.80 a share, just in terms of what it would cost to replicate this company. And that's something that Josh Young and I have talked about a lot over the last year or so. Is he always looks at it from the perspective of what would it take to rebuild this company from scratch. And admittedly, some of the vessels are older, so you wouldn't get 130 million for all of them. But if you wanted to build 26 VLCCs today, you're looking at $3.4 billion, or roughly $20.80 a share. And the company's trading around the $10 mark. Yeah, what can I say? VLC order book is at 1.9%. And yeah, 91 ships in the global fleet will be at that 20 years of age mark by 2025. And you've got 6 coming online by the end of this year. New builds. So you're losing 91 in 2025, or you can put on in this year and the next year sort of 6 to 8. Yeah, that's pretty simple maths that I think we can all follow.
Yeah, definitely. Okay, so let's transition to Cool Co. Which they transport liquid natural gas, right?
Correct. Yep. Correct. So this is a super interesting company. Almost no one knows about it or has heard about it. This was introduced to me again by my buddy Chapman Scarborough. So full credit to him. The guy's a genius when it comes to these sorts of opportunities. The valuation I have for the LNG carriers, based on what I think that they can do, I'm suggesting that this company is worth somewhere around $35 a share, and it's currently trading at about $13 a share. So, yeah, same kind of fundamentals. There's just not a lot of these liquefied natural gas carriers out there, and there are, I believe, only 2 publicly traded stocks of any importance. So those are good odds. If you want to get in on the theme, I suppose the overall the reason why liquefied natural gas is going to be a massive opportunity. You and I have spoken about the need for energy in the past. If you look at China adding 1.4 billion metric tons of coal by the end of the decade, what they want to do is they want to take about 500 metric tons worth of that coal and replace it with LNG, because it's a hell of a lot cleaner, right? So what you would look at is 500 metric tons of coal. That's the equivalent of 200 metric tons of liquefied natural gas every year. And the current state of the market for LNG is about 400 metric tons. So in other words, that's a long way of saying the demand from one player in this market is going to lead to a 50% increase in the market. So you've got a 50% increase in this market coming online, and you've only got 2 companies really that can play it, and you've got a tapped out fleet. So what do you think that does to their day rates and their earnings and all that sort of thing? Those are the questions that I ask myself.
Yeah, definitely. That's good. I'm just looking at the company's pretty new. It came public back in March, right?
I believe so. Yeah, they don't have a long history.
Mm-hmm. But you already got J.P. Morgan in there, Morgan Stanley, Citigroup. So it's and this is like a really new company. So,
yep.
Are you? So we talked about this a little bit before, but you're mostly focused on hydrocarbons and such. Are you into any miners as well, or what's your take on the miners?
The miners, oh god, I do have. Well, do uranium miners count? I do own a decent Denison.
Uranium miners or precious metals or platinum group metals or copper or whatever. Lithium.
Yeah, it's interesting. I want to buy copper. I just don't like any of the producers. Yeah. So in terms of miners and metals, let me see. What can I say? I've got some physical metals, and I tend to, when it comes to metals, for some reason, I tend to either go the royalty or the shitcos that are the way out of the money. For me, I'm just looking more and more into the royalties in my long dated value portfolio. they're just so much better in terms of a proposition over the longer term. What happens is when the metal prices may increase, great. But my question to you is, let's say gold hits $5,000 an ounce, just a random number,
Mhm.
and I do think that will happen. By the way,
Yeah, yeah.
not tomorrow, but over the years, I think that's almost certain. Well, what do you think a barrel of oil is going to trade for? What do you think a metric ton of coal is going to trade for? And those are the input costs to getting that stuff out of the ground. So for me, I'm interested. I had a look at Vale. If that were to drop, I'd probably take a bigger position. Otherwise, for me, it's all about the royalty codes right now in terms of the metals producers, with the exception of uranium. But I think that's a different proposition.
Yeah, Vale just like bounced back. They were just trading at what, $12 recently, and then they bounced back to about 15. I mean, they were just here at 12.44 back in October, and then but they trade in this range. They keep they drop pop like it's just consistent, right?
Yeah. I think over the long term, again, Vale being in Brazil, I think it's the number 2 iron ore producer. They'll be fine. They'll probably go nowhere for the next short term because people are worried about global recession, and if China has weak construction data, which they haven't, by the way, but if they did, then people would suspect that would lead to lower iron ore prices. You mentioned miners. I can't believe I forgot to talk about Sibanye Stillwater. That is one that I do own. It is a terrifying company in terms of it operates down there in
South Africa, right? It's in South Africa, right?
Correct. But this thing actually has a half decent balance sheet. It has interests outside of South Africa. I think that's important to understand. So if things really, really, let's just say the world ended in South Africa is, I believe, the number 2 global supplier of platinum. So platinum to me looks like it's standing on a knife edge. If things really get worse down there in South Africa, you're going to lose an enormous amount of global supply for platinum, and the value of their deposits outside of South Africa would obviously increase then. So they kind of have a hedge in that sense, and they've been able to. What the company has done is really quite remarkable when you think about everything that's happened in South Africa over the last decade or more. They've been able to survive. They've got their own private militia, basically, to defend their open pit mining down there. They've paid out some dividends. I think this is a case of something.
They got their own private militia, you said?
Yeah. I'm sorry. I meant to say security service. I misspoke, Daryl.
I'm like, that's concerning right there. Like, hey, you gotta hire a private militia, man. But I guess that's probably anywhere where there's a jurisdictional risk. That's probably they have to protect
absolutely. I mean, do you think Kazatomprom and other big companies don't have their own security personnel, let's call them? Absolutely. And down there in South Africa, if you listen to some of the comments from the CEO, like they have to defend their open pit mines because you got bandits coming through stealing stuff and who knows what. So I guess it's just part and parcel of delivering the metals that the rest of the world wants and needs. Yeah.
So my only conviction that I've been kind of averaging more into the ETF instead of going because I used to own Sibanye, and but the Aberdeen physical metal platinum shares ETF has just been clobbered. I mean,
it's a good way to play it. I own that as well as an easier way to hold some physical. Yeah.
I mean, it's trading at $83. I mean, just back in May of 2021, it was higher than that, and so that's kind of just the way that I've been trading this particular just to kind of have liquidity, but then also diversify the risk. Let's see what all they hold.
Yeah, I think that one should just be a physical ETF.
Oh yeah,
the physical. Yeah, the physical is just like a Sprott physical
like
gold trust type of deal. Yeah,
this is the other one I've been looking at too as well. The physical palladium. as well. I mean, this one has
Okay.
been getting clobbered too. Aberdeen as well. I mean, they were just trading at over close to 300 a share at
Yeah.
one point, and this was in the last 2 years. So Palladium's been getting just killed, man.
Steep decline. Yeah.
So I was kind of, it's like it's an opportunity, but at the same time, like I don't have I do have conviction about. I think that we're going to need a lot more combustion engines in terms of vehicles.
Definitely.
I mean, in order to do the electric vehicles, how we want to transition, we're going to need a lot more resources, a lot more, lithium, cobalt, nickel, copper, all of those things, right? Aluminum, so like we're going to need a lot of that. And that's going to take a while to even get that out of the ground. And so like, I do think that, that at some point the demand for this will rise again. But I mean, right now in the near term, like if we have recession, people aren't necessarily buying cars as much. And so I just think that it's kind of hard. It's like, okay, I'm averaging into this particular ETF, but knowing that I'm kind of managing risk because I just feel like right now the near term outlook, the near term and the long term, just kind of feels uncertain to me.
Yeah, definitely. I think that there'll be, as liquidity tightens, people buy less and less across the board. And when you get the selling pressure, people will sell everything across the board. So, as people sell some of their broad-based ETFs, you wonder why that puts pressure on seemingly non-correlated assets, but they do, because they just, stocks all trade together in a liquidity event. And
Mm-hmm.
it's up to us to figure out, well, just because the tech sector's crashed or the broad economy's crashed doesn't mean that uranium, for instance, I mean, it doesn't really care about that at all. It just looks for utilities contracts. So if uranium miners tank, and just because the broad market's tanked, then maybe there's an opportunity, just as one, I suppose, example.
Yeah.
Yeah.
Yeah, exactly. I was looking up the the rhodium chart because we saw this, we saw the rhodium chart. Like, I mean, especially over like, I wish I had got in on this,
The
before.
rhodium rodeo. Yeah.
Yeah, but like, I mean, 2020, it was near what like 5,000 an ounce. And then it just freaking just shoots up to, I mean, it's 30,000 an ounce, which I don't know what this is in USD.
Yeah, that's
Yeah. So now it's just like, just hovering down there. It's still a major premium on like, I mean, to buy a gram of physical rhodium, like the premium is still extremely high. But I mean, the price of it has just like declined so much,
Yeah,
But yeah.
I don't know anything about rhodium. I think it's kind of like a lithium. If you look at lithium charts, it went through the roof. I was like, Jesus, it looks like a battery type. I know rhodium is different to lithium, but yeah, I wouldn't even know where you buy rhodium. So no, I steer pretty clear of the old rhodium rodeo.
Let me see if I can find lithium. Let's see. I don't know if this carbonate. I don't even know if that's the same thing or what. But yeah, I mean, as you can see, I mean, palladium, so all these platinum group metals, just been clobbered.
Yeah, and I think I personally prefer platinum to palladium right now, just due to the relationship they normally, as platinum was trading super cheap to basically everything, including palladium. And another thing I suggest is that platinum has a larger use case than palladium. In other words, you can use platinum in medical devices and surgical instruments, but you can't use palladium for that. So I think that platinum does basically everything palladium does, but it also has the, I guess, the medical device benefit.
Mm-hmm. Yeah, and this is like for those who don't know, I mean, obviously this was a big run up here. I mean, in the 70s, I don't even know what was happening there. It went from 150 to about 1,000 an ounce. But during this time, for those of you that, just to put it in context for some folks, like this was a time where platinum outperformed gold. And so platinum was like, I mean, it hit, I don't even think gold hasn't even hit these level of highs. And so this was during the time when all the rap stars and the rappers were coming out. They had the platinum in the teeth, platinum on the necklace, like everything was platinum, 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 right? And platinum had, pretty much outperformed gold during that time. And then obviously you see a huge decline. It was funny because a friend of mine, he used to battle rap and stuff, and he had this platinum chain, and he said that when he bought the necklace, he bought it for quite a bit, and he bought it during this hype and everything, and then the Great Recession hit, and then you see this huge decline, and he didn't get as much for how much he paid for it then, because he sold it, and they were like, hey, the price of it's down now, we can't give you what you paid for it. And so, yeah, I mean, obviously it bounced back, but then, I mean, if you're looking at, the decline to where it's at now, it's a lot lower. So,
yeah,
I mean, I think a lot of this even came from like, when you see these packages, you see like the silver package, the gold package, the platinum package,
yeah,
top one, and so it's like, well, I think that has to be kind of changed right now. Now it's like it has to be silver, platinum, then gold. Gold is the top one.
Yeah, uranium package.
The
yellow cake clear.
Yeah, so like it's I mean, because if we look at gold, obviously gold had this run up, but it didn't hit the 2000 level that platinum did. And so I mean, right now it's near its all-time highs. So it's
gold looks to be super tight up towards the Tavi. You mentioned Tavi Costa. He talks about this a lot, that there's no such thing as a triple top. I mean, gold looks ready to break out. I mean, the Fed has paused, and traditionally that means you start to worry over the next sort of 3 to 24 months. But then presumably it'll go like this: the Fed will reverse course eventually when the market really has a sharp nosedive. And which, I mean, God, I've been expecting it all year. But if you look at where Fed funds rates are now, and you look at the last time they were at 5.25, the market was 30%.
I had the chart already up already.
Oi, here he goes. He's organized.
I had it up from a live stream a few live streams ago. But you're saying the last time they were at 5%, which what, 2006?
Yeah, it looks like that. And then we all know what happened 2008. I do understand it was a little different, but I don't see how most of these or a lot of these companies are going to survive. One interesting point, Tubby and Kevin and the boys talk a lot about how the Magnificent Seven is really, or the S&P 500 is really the Magnificent Seven. The Magnificent Seven is really the Magnificent Two. You got like Apple and Microsoft. Those guys have managed to fix in their longer term debt at fairly low rates, so sort of 2.9%, I believe, is the average. But the rest of the companies that are trading for sort of 50, 60, 70, 80 times earnings. I'm looking at Seagate because I hate that company and I've got a short. And
did you buy one of their hard drives or something and it crashed on you?
No, I just I looked at their balance sheet and it's absolute dog shit. And I don't know how they've managed to survive till the end of the year with the dividend, but I think it's going to get cut, and I think that they're going to get kicked out of the index, and I think institutions are going to sell their shares all at once, and it's going to drop 60%, and I'm going to make 80 times my money. I'm hoping. That is not advice, guys. Okay, that is not advice. It's just what I'm hoping will happen.
So looking at the balance sheet, anyway. We're looking at the quarterly balance sheet.
Yeah, and bear in mind, guys, since I started shorting it, it's gone up nearly $10. I mean, it's ridiculous. But
what parts of the balance sheet concerns you the most about this company?
So there is the debt levels, and then you've got what has happened is they borrowed money to pay out the dividend, thinking that they're going to increase their sales. Their sales are down 45% year on year, and the bloody stock price is up 45%. I mean, I don't know how that works. They've got a credit agreement that states that they need to have at least 800 million in cash at all times in order for them to pay their dividend. They somehow have kind of miraculously weaseled their way around that up until now. If you look at their cash equivalents as of June, they reported it at 786 million. So they're really right on the borderline to be able to pay themselves that dividend. And so what will happen is if they do announce they need to cut their dividend, then all those funds that I mentioned before that have to own the company for the dividend, they won't be able to keep it, right? And so they'll have to start to sell those shares.
Mhm.
So that's what I'm looking at. The cash just keeps declining. They issued more debt. They issued 1.8 billion in terms of notes that are paying like 3%. So I don't know who the hell wanted to buy that, but apparently they did sell it all. And they've been paying around 700 to 600 million a quarter in dividends. So a year, sorry, excuse me. And so, yeah.
That sounds like, and I know that when you mentioned the position on, I think it was you think you mentioned it on the Maverick. I think, was it the Maverick Life?
Yeah, quite possibly. Yeah,
But you mentioned that it was highly speculative, and so
correct.
you gave a good forewarning, and so I didn't touch it. I was like, yep, I'm not touching this one.
Well, so far you have been right.
I was I'm like, hey, if they go burning down or whatnot, then cool. I'm in a different. I'm gonna jump in a different trade. I mean, that's kind of one of the things I've learned is like if you're going to speculate, that's fine. That's good. You can definitely, I mean, you have a pretty good thesis for this company, but I've learned like not to like chase every trade. It's
certainly.
I've lost money doing that. Jumping. Okay, this is a good thesis over here. Let me jump to this trade. And so I just try to stick to what I know. And like, I'm like, hey, shorting in general, even when I talk to Jim Rogers about shorting, like it seems just very challenging.
It is, because there's this, you can be 100% right in your thesis and just get the timing wrong. In other words, it can throw you out from the timing. So to give you the cash flow per share on this thing is about $3. Okay, so you're paying it's insane. It's absolutely insane. And they are about to run out of cash. Oh my God. But obviously it's taken a hell of a lot longer than I thought. I have
the earnings ratio right now.
I'm hoping, or my thesis, my shorts are dated around January 2025. So I do have a lot of time for this to play out. They've got 123% loading in terms of their assets their liability to assets. So I hate it. I hate the thing. It's at like 54%, 54 times PE.
Is this like a zombie? Is this what they call one of them zombie companies or what?
Yeah, absolutely. It doesn't make any money. Its debt to EBITDA is at 16 times. I'm going to say that again. It's at 16 times. When you're, and Rick Rule will tell you this, if you're a banker and you want to lend out credit, the maximum you would normally allow is 3 times debt to EBITDA. So me running private businesses, if I went for a loan, they'd want to see no more than 3 times debt to EBITDA. And this thing's at 16.6. I mean, I don't know. I went on a rant there, but
no, that's good. That was good. Everybody, whoever's tuning in, be sure to drop a comment. Love to hear from you. If you got any questions or anything, be sure to drop a comment. Let us know you're here. Let us acknowledge you and everything. I appreciate you all watching. Seems like we're keeping the attention of quite a few people. So I did want to jump back to the federal funds rate. And so as we can see, when Rick Rule talks about we've been in a 40-year decline of interest rates. I mean, interest rates peaked in 1981, and then we've been in a decline since then. And so he talks about how I mean, obviously, since the global financial crisis, and I mean, they took rates to zero, for
Mhm.
years. And so it seems like, well, when Rick talks about this, he talks about how the landscape for investing has changed. Like back then, you could do the 60-40 portfolios, and you could get into a bond, at, I mean, what, 20%, 10%,
Yeah.
15%, you could get into these bonds at 11%. You could probably buy 11% bond, for
Yeah.
30 years. Like, hey, government, hold my money for 30 years, pay me 11%. I don't have to take any
Absolutely.
risk.
Absolutely.
Obviously there's risk with governments going insolvent and such, but I mean, like the likelihood of the United States doing that it's pretty low because we have the reserve currency status or whatnot. But now, it's, I mean, you're looking at now we're at the zero bound. Now we're back to the 5%. And so I'm hearing like some people saying like, okay, we believe that interest rates have bottomed and they're cyclical and they're going to go up again. Then I'm also hearing that the rates have to drop again and we have to let inflation run hot, and inflation to kill off the debt. So you have any perspective on that, man? That's kind of like one of the things where I've been like, okay, because some people are considering like, hey, if I lock in a 30-year treasury bond or a treasury note or whatever, then they can lock in at 4.25%, 4.5% or whatnot. I don't know the exact numbers, but
Yeah, it's
you know,
lower. It's lower than the Fed funds because the yield curve is all inverted and very
yeah,
unhealthy.
exactly, exactly. And so like people, some people are thinking like, okay, I can lock this in here because they're expecting inflation to be lower than the rate of return from the bonds. And so but for me, like I don't think the inflation fight is over. I think that inflation is going to come back.
Yeah, I tend to agree. I think that it's so interesting. If you look at where you pointed out the end of the 70s inflation, where we got up to well, it's 18%. That was with a much lower debt load for the U.S. government's balance sheet. We are at 130 percent, and so I don't think they can raise rates that high. However, there is the option where they need to make believe they're raising rates to make believe they're fighting inflation, and obviously that can't that will wreak havoc and bankrupt the government. So what they then will do is issue currency notes, and this is what Cuppy refers to in his Project Zimbabwe thesis of they can't really lower rates because inflation will go through the roof, but they can't really raise rates because that will increase the servicing costs of their debt, which is just getting worse and worse every year. So you get the Project Zimbabwe playbook, where you issue currency to pay the increase in the debt, but then the issued currency increases inflation, and it's a pretty vicious cycle. So I don't know if that will happen. I find it difficult to believe they'll be able to raise Fed funds rate for now much further, and they have paused recently. Let's remember, with regards to a 30-year bond at 4%, I can't think of anything worse right now. Yeah, I could be wrong, but I don't see inflation being really less than that over the longer term. When you look at that 4 decades worth of declining interest rates, I don't think we're in for another 4 decades of that happening personally.
Mm-hmm. Yeah, definitely. Um, yeah, I was hearing from someone, they were talking about Zimbabwe, and they said that Zimbabwe's stock market has been skyrocketing, and I think they went on the gold, like a partially gold back system or something like that. I haven't looked much into it. That may be, it's probably a good thing for them if they did, but I'm just going to share the the screen for treasuries. So currently, I mean, you're getting paid out at 30 year. The 30-year bond is paying about 4.75%, and then 10 years about 4.5.
Yeah. So why would you take 20 years extra risk for an extra quarter, a quarter of a percent return? I mean, this is where, and Stanley Druckenmiller makes a good point here when he says that Janet Yellen had the chance to issue more of these maturities for longer dates at lower rates, and I don't know, she didn't. And so you've got about 40% of all the debt due to roll over in the next 2 years. Now, the debt was issued at round about 2.1, 2.2%. I've got the numbers here somewhere on a separate piece of paper. And they will have to refinance that at the new rate of 4.5%, 5%. So that's a doubling of the interest rate on what the US owes, happening to 40% of its debt maturing in the next 2 years. So
Yep,
yeah.
exactly. And that's why, for me, like I've been I have some money in some T-bills, like I'm like, hey, I'm not going to loan the government money no more than, I haven't even bought the 52 week. I'm mostly doing like the 26 week or less. But I mean, you're able to get, 5.4%, 5.3%, on the short term, and you're able to get your money back quicker. So I'm definitely not locking my money away for no extensive amount of time. I mean, even the notes, the 2 to 10 years, I mean, you're only getting 4.5%,
Yeah.
So,
I think people buying bonds now are really looking for a reversion trade. If they do pivot and start lowering rates or buying back bonds, obviously you might get a capital gain there. Look, that could happen. I don't know. I don't like the risk reward personally, but the short term bill you're buying, I'm sure that'll be fine. 30 days, 60 days, 90 days stuff is not bad to be paid 5% while you wait.
I mean, even the ETFs, I mean, TLT, the TLT has just been getting massacred.
Yeah. We've seen the worst bear market in the history of bonds. And no one seems to bat an eyelid. No one seems to care. It's crazy. Look at that.
Yeah, that's terrible. So yeah, it's definitely one of those things where I'm just not gonna touch it. I am, I touch so I have some dry powder built up in treasury ETFs, treasury bills, but then also bill the ETF. I mean, which will pay you, about 4%, 4.3%. But this is all 1 to 3 month T-bills. And so this is just dry powder just sitting, in case we have a big downturn. I've also started back investing in treasury inflation protected securities. But this is one that Lynn Alden pretty much stated that she buys, and she gave her thesis why. But this is another one that that I'm looking at right now. So I'm not really touching a lot of government debt that I can't, I just can't lock my money away for that long. And then we have the national debt clock. I mean, obviously, this is this is just getting bad. I mean, we're going to be at 34 trillion at some point, probably this year. And then we have I'm trying to find an interest expense. We have the interest expense on the debt, which is total interest paid. And then we have I'm trying to find it. I forgot where I found it at. But you have the interest expense on the debt as well. So right now, with interest rates being higher, we're paying a lot.
I think it's coming up to 6% of GDP, and with the stats that I mentioned before, a couple of guys are expecting that to get to sort of 29, 30%, which is, I mean, that's insane. Imagine if you had 30% of your income going to cover a credit card debt. as an individual, it's not looking good.
Yeah, definitely. And we're at 120, close to 125% debt to GDP.
Yeah.
We're looking like the 1940s, which there's always this comparison between the 1970s, which we had a lot less debt during that time, and the 1940s, where we were in a world war.
Yeah.
There was massive deficits and such, and so during that time we ran over 100% debt to GDP, and they had to inflate the debt away. So some people, that's the argument for allowing interest rates to drop, inflation to run hot, which is going to benefit commodities, especially oil, and during that time allow the taxation and all these different things to pretty much reduce the amount of debt we have. But obviously it depends on who's in office and what type of rescue packages they want to dish out. We're not.
It's interesting. I don't know. I mean, whoever's in office, they inherit the debt problem, and exactly as you mentioned, they have to decrease the net present value of that debt by letting inflation run above the funds rate. So I don't know. I don't see a way around that. I just think that they're going to have to. Inflation's not the bug; it's the feature, and they're going to need inflation to reduce the net present value of the liabilities. They being the US, of course. We're all, I'm focusing about the US because they're the biggest player on the chessboard.
Yeah, we have a lot of which I have Brent Johnson coming on soon, which he talks about
Awesome.
how with the amount of debt we have, that's how much we have in other nations that owe the US or whatnot. And so it's going to be interesting conversation that I have with him, but he has some interesting perspectives that I like to learn from. Let's go look at Ozzy, man. Where's Ozzy at?
Ozzy down here. We're not as bad. but we don't have any reason to celebrate because we're doing some pretty silly things. If you look at the external debt to GDP of Australia, that is a little worrying because what happens is Australia does have foreign sources of funding capital, and so you don't want to. If you look just above there at Argentina, you don't want to get into the Argentinian situation of borrowing in currencies that you can't control. So that's just one thing for Australia. Australia is pretty lucky. We get to sell visas and passports is a big industry here, and then dig stuff out of the ground and sell it to China. So as long as those two industries are strong, Australia seems to get away with very silly economic policies. If those things go into recession, then we tend to get into trouble.
Yep. That makes total sense. And you're looking to move to Australia next year, so you'll be able to get paid in what, dollars? And
Argentina, yeah. So my portfolio is set up in mainly US dollars, but there are a couple of nice Aussie coal companies that pay me Australian dollar dividends. And yeah, that's the plan, the geo arbitrage. I'll be traveling around. I've traveled around Latin America before, so that's the plan in a nutshell.
So we gotta get you at the World Symposium next year, July.
Oh, July I'll be there.
We
got nothing else to do, so that's in Miami. Oh, Boca Raton.
Boca Raton. Yeah, we got to get you out there to question some of these companies with me and such.
Okay, no, done. My plan is I got a buddy in Mexico in June, so I can skip across to not to Miami, so to Florida in July. Easy done.
Nice. All right, Ben. Well, we're gonna go ahead and close out. I got to get back to the fam. Where can people find more about you? Well, I'm just gonna pull up your channel again.
No worries. So I'm on Twitter. The handle on Twitter is @themavlife. So that's me sharing how I've lived my life as a maverick, just going off the beaten path. And of course, the ROI channel is the main channel for YouTube, where I talk about all investment type
And you have a Substack, right?
Correct. Thank you for reminding me. I nearly forgot. So I have an entry level Substack, which is the ROI Club. It is, if you pay annually, it's less. It's like $5 a month.
I
Okay,
just
so
know
it's
that
nothing.
you put your head on. Is that Tom Cruise there?
Yeah, that's right.
Is
Yeah, the whole Maverick thing. But the ROI channel is very cheap, guys. I go through the analyses like what I did today with companies that I don't necessarily share. The whole portfolio over the year is up 300%, including dividends. And the Maverick Life, which is my premium publication, is where I share how I make the income needed for me to live abroad by selling options. So check that out. There's free access and free trials. You can all take a test drive and see what you think. I appreciate you letting me come on and share that.
Yes, indeed. Yes, indeed. All right, you all be sure to check that out. Thank you all for joining today. Be sure to go subscribe, give Ben a follow, and check out the Maverick Life. You all got a wealth of content today. This should be something you could chew on for the next 2 days or whatnot. But you got a lot of content today, a lot of value, a lot of stock picks, just things that we're investing in. Nothing on this channel is financial advice, and so. Thank you all for joining us today.
Thanks, guys. Awesome.